high-yield bond market in Europe has been very buoyant for 2 years. It's obviously, like all the markets, had a prolonged summer vacation, but it's certainly clear that most credit investors see high-yield bond here to stay as a permanent part of funding structures. So I am confident that it will reopen. Exactly when, nobody really knows the answer to. There is a good pipeline of names waiting to issue, some with more pressing needs than others. And it will, I think, continue to be a permanent feature in the capital structure and take market share away from the traditional bank loan market. The European high-yield bond market has been extremely buoyant for 2 years, but it's far less standardised than the much older, more established and much deeper US market. There's a lot more differentiation within Europe in details in the covenant package designed to protect investors. For example, the note holders put option on change of control. There's been a lot of variation in that, particularly in the last 9 months. And there are other aspects of the covenant package designed to protect investors where issuers are still continuing to push what they believe the market will bear in terms of latitude and flexibility for the issuer on the one hand, obviously, but further weakening for investors in terms of their protection. And I've no doubt that that is going to continue because, as I say, the market is still developing and evolving over here in a way that is perhaps not true of the US market, where things are more standardised than is the case we've been seeing in Europe. I think that the main areas at the moment of contention are a change of control, in particular the introduction of an additional limb to the test of a ratings downgrade before note holders can exercise their put option. There is also the importation of features seen more widely in the US now, such as the ability of the issuer to redeem 10% of the bonds each year at 103% during the non-call period without the expense of the traditional make-whole regime. And that is appearing more in Europe, and it will be interesting to see how widely that gets replicated in Europe. I also think that there will be issues about the extent to which the issuer group, particularly where it's owned by private equity sponsors, can pay out not just dividends, as one would expect, but all sorts of other expenses and fees, which in some people's views are in effect just another disguised dividend.